My name's Elaine Hagan. I'm at UCLA Anderson School of Management, and with three of my colleagues here who each have a different perspective of investors. We're going to tell you a little bit about the technologies they're seeing, what stage they invest in, how they work with the companies, and then open it up to all of you for Q&A. On my far left, I'm going to say this not quite right if I don't look at it. Chang Yu, she has just told me it is Chang, not Chang, so who is with UpFront Ventures. Amir Naiberg is here in the middle, who is with the UCLA Technology Development Group, which was formerly known as our Office of Intellectual Property, and which also has an investment fund that they use. And then Gilman, who's over at Science, which many of you know as an incubator here in Santa Monica, but which has a new blockchain division. I'm under strict orders not to tell you more about their bios because Joel and Jim have assured me all of you can read the material that's in the packet, so we're going to leave that to you. But what we are going to do is go down the panel first so they can just tell you a little bit about the areas that they're personally investing in and their firm itself. And so we're going to start with Chang on that front.
Thank you for having me. UpFront Ventures, we're based in Santa Monica. We've been around for over 20 years. We're a very traditional venture capital firm in that we're just financially motivated. Our LPs, our pensions, endowments, family offices, foundations, and the like. And we have currently investing out of our sixth fund of $400 million. We primarily lead seed and A rounds, so we're early stage investors, but we typically write $2 to $6 million checks to lead a seed or A round, and we typically take a board seat. So we have many board seats as a result, and we are very active with the companies that we do invest in. As for me personally, I invest in technology that augment the human potential. And for me, some areas that I spend time in include future of work, AI, machine learning, robotics, and old school industries like logistics, supply chain, and most recently, construction.
Amir?
Hi, Amir Naiberg. I'm Associate Vice Chancellor here in UCLA. I'm leading the UCLA Technology Development Group. What we do is we look for innovation created here in UCLA, mainly by graduate students and faculty, give it a legal packaging, typical of a patent, and then we go out and partner with investors or multinational companies to make sure that these innovations, these patents are translated into products in the marketplace. And I think I'm here today because we also have an investment arm, and the investment arm is the UCLA Innovation Fund, where we take early, very promising scientific projects and with some mentorship and investment try to make them and turn them into a financeable opportunity.
I'm Gilman. I'm one of the founders of Science, which is an incubator, accelerator, and venture fund here in Santa Monica. Science is 7 years old this month. We started with a $40 million incubator vehicle, which was primarily funded by local venture initially, and then ultimately by the Hearst Corporation. Out of that, we founded or funded about 75 entities and have had 1.3 or so billion dollars in aggregate exits out of that, the best known of which was Dollar Shave Club, which we co-founded with Michael Dubin when it was two guys, a pallet of razors, in this video that was about to launch that was going to change the entire face of CPG. Subsequent to that, because we didn't have a venture fund at that time, and nothing will make you want to have the ability to follow on an initial investment, like having a $1 billion acquisition where you just get diluted the entire way. So we raised a $75 million venture fund that predominantly invests in the winners coming out of the incubator. We've been involved in the blockchain space for about 6 years now, and about 2 years ago, we decided we wanted to create a dedicated blockchain vehicle, and because we like complexity, we decided we were going to fund that by selling a security token, which was the second one ever sold at that point, and Blockchain Capital had figured out how to tokenize a venture fund, so we said, I'll see you some crazy and raise you one, and we made our token even more difficult. And instead of raising capital from our traditional investors, whether they're venture, high net worth individuals, sovereign wealth, U.S. states, we ended up raising from a whole bunch of accredited investors, most of whom were sort of like ETH millionaires sitting somewhere that generally would never be a part of a roadshow to find LPs. But we learned a lot, and it was a great experience, and we're now actively incubating blockchain companies as well.
Amir, can you tell us a little bit more about the source of the funds that created the Innovation Fund, and then what types of, where you invest and how you, I know you do some proof of concept grants, but I know you've made other investments as well.
Yeah. So I think by now, almost 3 years ago, UCLA went out to monetize its biggest, at that time, biggest intellectual asset or biggest license. And that is a license covering a drug called Xtandi. Xtandi is a drug for the treatment of prostate cancer. It's currently sold by Pfizer and Astellas. And it was created here in UCLA by, in the labs of doctors Chang and Soyas. And so because the university is entitled to an earned royalty on the sales of that drug, and the sales of the drug were soaring, the university said, okay, we need to mitigate our risk. And one way to mitigate the risk is to sell the royalty stream. And the royalty stream monetization was very successful. And that's in the public domain, around $600 million made their way to the university. And so the Chancellor and everyone else said, okay, this is a good business model for us, and we should invest in a pipeline and create more exits like this. And so most of the money went out to promote the university's traditional causes of education, scholarships, and research. But the Chancellor committed $1 million a year for the next 5 years to allow us to use some money and some resources to bridge the known gap between scientific project and a financiable opportunity. So what we were able to do through very good execution is go to some deans here on campus and tell them, hey, we have $1 million, we can do about 4 projects a year with that, but if you'll match our funding, we'll do much more. And so with primarily the School of Medicine, but also the College of Physical Sciences and School of Engineering, we're able to leverage that money and use almost $2 million a year in order to invest in these projects. And we have a fairly sophisticated model on how to screen them and how to manage them.
Great. I want to get a little more into the theme of the conference, the technologies, and ask each of you, you have a faculty member or a scientist or one of your portfolio companies or an entrepreneur shows up in Chang's office, they tell you about their company. What frameworks or methods or people do you use to assess technologies in companies that you're looking to invest in? Chang?
It varies widely based on the technology. On one side, you could have a social app, which honestly is not that hard to replicate. So if you said that you built a model yesterday and you have 2 users, then I can find someone else who can replicate that very quickly, and you don't have something that's defensible. On the other side, you can have technology that's been patented and that you are the only person in the world that could really build this because you just spent the past 6 years of your PhD working on this particular topic with the best-in-class researcher. And that's technology is very defensible. So if I want to take a look at the spectrum, on this far left side of the spectrum, we primarily will look at the founders, the team, the go-to-market. Do they understand all of those aspects? Do they have something that's differentiated? Are they going to build a product that's really head and above shoulders above everyone else? And can they take it to market and make money? On the far right, then I think the question that you asked applies more, where then it could be a technology that we don't understand as well. So we will try to understand the technology based on our expertise, also based on the expertise of our networks. So for example, we invested in a nanorobotics company that used nanobots to deliver drugs to a targeted area in your organ that's otherwise hard to reach with the traditional cancer therapies. And this is deeply technical, but we were able to validate with experts from our networks, and also we got comfortable with the backgrounds of the people on the team that we felt that this was a very solid technology moat.
Amir?
So we know that we don't know, right? UCLA is a $1 billion research organization, and through our open call for proposal, we're getting almost 50 applications a year just for life sciences for our investment vehicle. So we developed a screening tool that has 2 stages. The first one, it's simply good old traditional peer review. So for all the 50 applications, the LOIs that come in are being peer reviewed by other faculty members here in UCLA. And that cuts down the list from 50 to around 10. On those 10, we do a deep dive diligence on the IP to make sure that we actually own the IP, we have no partners, there are no third-party obligations, and so on. And that will cut down the list to around 8. From those 8 are being presented in a pitch day to investors, and the investors come from both corporate VCs or traditional VCs. One of the UpFront partners is a regular guest in these panels. And these panels are advisory, but they give us a thumbs up, thumbs down, should we finance these projects. And this is how we narrow down the list to around 5 where we invest money and give mentorship and project management for about 18 months.
Because science gets involved so early with companies, it's a little bit different, I think, than my colleagues up here. We're often looking at companies when they're at the stage of 2 people and an idea, and I think we've seen on the blockchain side of the house about 600 or so companies in the last 12 months, and we're now working with 4 of them. So it becomes an exercise of screening first from concept, right? Is this a concept that we think actually has the potential to become a real business? Second, team, right? As basically every professional investor will tell you, you're always betting on the team because something is going to go wrong and in every company, and the team is going to figure out what's going to work. They're going to find the solution if at all possible. So first concept, second team, and then we're ultimately looking for things that we can find follow-on financing for in all of our incubators. So my partner Peter, his sole job is to figure out what's fundable and to get them funded. We've raised about $600 million in follow-on financing for our portfolio companies at this point, and then it's almost all gone through him. So we won't choose to get involved with a company if Peter doesn't get validation either locally or from the Valley that this is a concept that is fundable if it works. So we sort of go a step or 2 earlier than most. And frankly, when we talk about writing checks into early stage businesses out of our fund, I'm amazed that folks like Chang can actually meet a business, get to know them over the course of a few weeks or a few months, and actually write a check. Like, we need high confidence, which means we're generally spending a minimum of 3 months actually operationally working with the team before we write a check. And that often looks more like 6 months or a year before they get the additional financing coming out of the fund. As for what technologies we look for, we're generally very consumer-oriented out of our main vehicles. I think in 7 years, we've had 2 companies that have filed for a patent. We're generally looking for companies or concepts that can reach a lot of people, and the metrics that we're looking for are their cost of acquisition and their lifetime user value relative to that cost, right? So we will smoke test even before we'll let them spin up a product and figure out whether this is something that they might actually reasonably acquire users or customers for at a price that will make the business work. And if it doesn't, then we won't get involved with that concept.
Greg, I have one more quick question. We were talking outside, and you were explaining the derivation of the science name. Will you just share that with everyone else who might not know, because
Sure.
it's a little interesting?
So, generally we try to make data-driven decisions in everything we do, and we encourage/require our portfolio companies to do the same. So, what we're looking for are, as I was just talking about, sort of what are the core metrics that drive these businesses, and we make sure that the companies are aware of them, and we're deep in their data, probably more so than most of the entrepreneurs would expect when they come to work with us initially. But we're trying to instill sort of, best practices for them moving forward to understand what really drives their business. And that's ultimately why we decided to call it science.
Great. So you've written the check now. Chang, can you tell us a little bit more about how you work with these teams after you've written the check and they become part of your portfolio?
So we often have a board seat, which means that we are a board director. We represent, as a board, you represent the shareholders, and we represent primarily our interests, but also the interests of the broader shareholder base. And how we work with companies varies a lot, depends on the stage of the company. If we invest in a slightly earlier company at the seed stage, then it's often very tactical. They need to spin up marketing. They need to think about performance marketing versus brand versus content marketing versus any of the other channels. Within performance, you need to think about Google versus Facebook versus Instagram versus buying something else. So we're very tactical in that we offer our advice from what we see across the rest of our portfolio and across the companies that we meet. And we also connect them with either it's agencies or local talent that can help them to figure out what works for them. When it gets to the Series B or C stage with some of our portfolio companies that are a little bit later, then the way we work with them is primarily at the strategic level, where the CEO usually has an executive team across the main functions that can help him to run him or her to run the parts of the business, and at this point at the board level, they're elevating to us what are the strategic considerations for this company, what are the long-term vision, and what are the key questions. Should we go with this model, or should we change this model? Should we stay in consumer? Should we change to a B2B? Are there enterprise opportunities? Should we go international? Should we sell through channel? And all these strategic considerations is what we really spend time on at the board level. And we think about transformative business partnerships that could really help them to get to the next step. And we also think about bringing in executive talent and bringing in industry leaders as independent board members to really help this company accelerate their growth.
Amir, I know you have a new ventures team. Is that who works with some of the companies, or how do we do it at UCLA?
Yeah. So one of the most challenging conversations we have with faculty members is the following. Tell them, hey, you won the award. We're going to work with you for 18 months or so, and we're going to invest $200,000, which is a lot of money in academia. But you're not really going to get the money. This is not your regular award coming from NIH or someone else. And the money is going to be controlled by our new ventures team. And actually, you're going to have a project manager that will work with you, develop a work plan and a Gantt chart, and you're going to have milestones, and you're going to tranche the money if you hit the milestones. And this is not how your faculty members typically works. But they get it. I mean, I think they do get it, and we really try to, part of the art is matchmaking the project manager with the faculty team, make sure they work well together. And then we go out to this adventure where we coordinate all our efforts from our office, from our new ventures team, working with external project managers, getting feedback from our advisory panels. And basically, we're running this as a true fund where we close projects that don't hit their milestones, and we double down on some projects that are doing really, really well. Another benefit for us, and as if projects actually fail, don't hit their milestones, is we can also save on patent expenses. Patents are a very expensive endeavor for the university. So if we see that a project fails to hit their milestones, we conclude that it's unlikely that we will be able to license or commercialize it, and so also close the relevant patent family, which also helps us to save some money for the university.
Too many more, or what you already said?
I think we pretty much covered
Okay.
it. Yeah.
Greg, you talked a little bit about the ICO, and your words, we do a little crazy. We'll raise you.
Yeah.
Can you go a little deeper into the whole ICO process and why you chose that route?
Sure. So, we'd been involved in the blockchain space for a while, and 6 years ago or so, we built like a Coinbase competitor, and we had a mining operation. we basically had a mining operation because power was included in our lease. So, our landlord didn't make that mistake the second time. But, we built a whole bunch of operating businesses, and then our banking partner decided that when they also decided to stop supporting Coinbase, they were going to stop supporting our operating businesses as well. So everything sort of went into the deep freeze for a while there. Our board, which was absolutely the right decision at the time, said, hey guys, we know you like to be way out there on the edge with some of this stuff, but if you can't get your businesses banked, maybe that's a sign that you've gone like one step too far. So in the greatest destruction of value in science history, we turned off all of those companies. But we all remained, my partners and I all remained individually interested and invested in the space. And then about 2.5 years ago, sort of corresponding with the rise of the beginning of the Ethereum ecosystem, we recognized that this native incentive mechanism that companies could use by building or issuing a token on Ethereum could potentially solve problems that traditionally took startups either lots of time or lots of cash, right? So, for example, cold starting a marketplace is really hard because no buyer wants to be somewhere where there are no sellers, and no sellers want to be somewhere where there are no buyers. But you could use a token to basically incentivize/pay them to show up, right? Which could really increase the speed with which these businesses could develop. So we decided we really wanted to understand it and started to dive deep. And right around that time, Blockchain Capital issued their security token, and we had been friends with that team for a while. One of the businesses years ago was cooperated with one of their partners, and they said, hey, we sort of figured this out, and they had spent an ungodly amount of money to try to figure it out. And they said, somebody else should use this, right? And you guys are probably the only other ones that we know that are both sophisticated enough and, risk tolerant, I think is probably, / crazy enough to try it yourselves. So they delivered this sort of blank canvas of here's how you do a legal security token offering. But I looked at that and said, I don't want to just have a tokenized fund, because it's interesting that the token could trade on an open market and an LP could get liquidity at any time based on the NAV of the token. But I wanted to go one step deeper. So with our token holders get directly any tokens that we as the fund get for our incubating or investing activity. So we take the majority of those tokens and automatically send them out via smart contract to all of our investors, right? So it basically makes all of our LPs liquid with respect to the portfolio companies. Now, LPs are not generally liquid with respect to the fund itself, let alone the portfolio companies. So I really like that mechanism. So we sort of created this token, and then I went on this multi-month roadshow around the world where, as I said, you're pitching to ETH millionaires in Kiev instead of doing a roadshow to the traditional LPs. The reason we did it was sort of twofold. One is the reason we have credibility with entrepreneurs in the first place is all of us have started and founded and sold operated companies, right? So when our portfolio companies look to us for guidance or advice, they know that we actually have a leg to stand on in providing that advice. And I felt it was essential to really understand the ICO process from the inside if we were going to help our portfolio companies do this. So by running what was, or perhaps is still, the most complicated sale on the face of the earth, we sort of got some of that credibility. The other piece we got out of this was a network of accredited investors globally that invest in these projects. So that's sort of the unfair advantage that our portfolio companies get, is we can introduce them to the hundreds of accredited investors around the world that are actually interested in this space, that we've gotten to know by, going through the sale process ourselves.
Sure, super. You've all shared some of the technologies and stages you invest in. Are there any new emerging technologies that you're kind of paying attention to, watching, or issues that you're thinking about? And I know, Chang, you mentioned the future work, but can you share some of the technologies you might see in Los Angeles or elsewhere that you'd like to do a deeper dive on?
Yeah, the reason I love LA is because there are many strong tent poles in the local economy, in addition to tech. So there's entertainment, there's gaming, there's manufacturing, there's logistics, there's aerospace. And all of these, and perhaps connecting with each other, create really interesting companies to back. So one example is last year we backed Envia Robotics, which is a fulfillment warehouse robot company. They make robots that can go around the warehouse to pick the boxes from the shelves and bring them to the humans, so humans don't have to walk around the warehouses anymore, and they just have to pick the items from the boxes and packs and ships. And this team was out of USC Robotics, and they had previously founded some other LA-based companies, Edgecast, that was sold to Verizon, so a bit of an enterprise company. And we see local talent building really interesting companies here. Their first customer was Holler, which is also a LA-based company. In your portfolio? My bad.
I don't think so.
But they're in the portfolio of some local funds. So Holler had these warehouses, and with Envia, they were able to prove that they could put dozens of robots in those warehouses and allow Holler to really lower their cost to serve and make it much easier to hire, well, much easier than hiring the entire new staff to staff of a new shift. So Holler, why is Holler here? Because there's a lot of e-commerce here. There's logistics here. There's manufacturing here. And so there's all of these reasons that make LA really great for different types of technology startups emerging.
Amir, is it driven by what's presented to you by the faculty, or are there areas that your team reaches out to learn more?
So it's mainly driven by what is presented to us by faculty. If we're looking at trends, obviously after the acquisition of Kite by Gilead, everything's got to do with CAR T therapy, immuno-oncology is booming these days. And you can actually imagine a belt between Thousand Oaks to here in Westwood, where Beth Seidelberg has her new fund in Westlake Village. So this entire biotech ecosystem is really coming to life. That's a very recent development. Personally, we are getting more and more interested in what's going on in this part of the campus, what's known as Northern Campus, which is less tech-oriented or perhaps hard sciences or life sciences. And we're thinking about how to engage the community around this part of the campus with our office. We have a pretty well-established and good playbook as far as life sciences, physical sciences, and engineering is concerned. Less so about the softer sciences. And so we're working with Startup UCLA and other organizations here on campus to figure out how to capture value and help entrepreneurs and faculty members get out and establish new startup companies around in this area of the campus.
As far as trends or things that we're looking at, always we are focused on consumer-driven companies first. So looking at companies that are going to touch millions or billions of people, ideally billions. I don't know if we've gotten there yet. This generally looks like CPG companies, which we think right now, largely due to millennial influences, the CPG landscape is changing really quickly. After we did Dollar Shave Club, we sort of stopped doing a lot of CPG and e-commerce for a while, which was kind of a waste, I think. We just weren't seeing companies that we really liked, and they also became really capital intensive, which, given the size of our vehicles, isn't necessarily ideal. But I think the landscape has changed even in the last few years, and we're looking at those again. We continue to look at marketplaces. Dog Vacay was another one of our companies that merged with Rover, and we tend to like those consumer-oriented marketplace businesses. And then we look at media and mobile as sort of a combined sector that is converging probably into one overarching thesis for us at this point. And we have a few investments in that space currently. But we do not generally look at anything that Amir likely has invested in, right? So we are the other end of the spectrum because we frankly don't, that's not our DNA. We don't have anybody at the partner level or even at the sort of rung down from there that has any real hard science background. We've made a handful of investments there, but that's generally because we have good relationships with the firm that was leading it, and they said, hey, this is something that you guys might actually like, and we think this is an outstanding opportunity. And generally, we've done well following in those investments, but it's not something we would generally look to lead.
Good. One of the things I told the panel is I would find out who's in the audience because we weren't exactly sure. So from a show of hands, do we have some law students here? And then some attorneys? Okay. And any entrepreneurs? Okay. So this one's for the entrepreneurs a little bit, and maybe this is Chang and Greg, but one of the things entrepreneurs in Los Angeles often wonder is where do they get that initial funding? And as the investments for the venture capital firms are moving up to 4 to 6 million, I'm wondering what you might be seeing as first investors. Is it the traditional friends and family and then family offices, or anyone else moving in to fill that space? I know on campuses, there's a lot of competitions that provide non-dilutive funding, but it just seems like a pain point that we continue to see in multiple sectors.
I see more and more capital at the stage earlier than us, which is fantastic. I think in the beginning you had the PayPal mafia, but now there's a group of Uber employees that made some money that they are investing. Yesterday, I just met a group of Twitter employees that started an angel group called #Angels, and then I think there's some crypto. I don't know if they're millionaires, but who got some crypto money, or some Snap folks. That I think there's more and more local angels at the earliest stages, and they also have operating experience, which is really helpful for you as you raise your first funding. And then after that, if you're ready to go institutional, there's pre-seed funds and seed funds, and there's been a huge number that have emerged recently, and they're all good at certain things, and they can provide expertise to certain types of companies, and they're great partners for startups at the earliest stages. I do think that there's a lot of variety of capital, so you can talk to different people and see who is the best fit to provide the best resources for you and to be the best advisor for you as you're building your startup. We sometimes are first check-in as well. So that's also possible.
And we're trying to be helpful for startup companies coming out of UCLA. We have a program called Startup in a Box, where basically service providers, the lawyers among them, offer some pro bono services for people who are just getting started, as well as introducing companies to investors and angel investors in our network. Amy Wangudis was here earlier. Is he still here? No. One of her investors actually, during his due diligence, spoke with me, to make sure that everything she told him is truth. And so we really try to encourage and be helpful to all of the entrepreneurs who are UCLA students or faculty.
I think there is a lot of capital available for seed stage companies right now, probably more than at any point in history, basically. There are, I can't even count how many incubator programs or accelerator programs around the city at this point. When we started 7 years ago, we got a lot of questions from LPs, like, how are you ever going to get enough deal flow in LA? Shouldn't you do this in New York or maybe up in the Valley? And now, fast forward 7 years later, the same LPs are now saying, oh, LA is the best startup market in the world, go deeper here, and forgetting that, previously they'd been a little less gung-ho on LA. But I think in general, there are so many potential avenues for funding at the earliest stages right now that if you're an entrepreneur and you can't round up your first couple $100,000 from one source, then you should, or from one source or another, you should probably really take another hard look at the concept, right? Like, it's one thing if you don't know anybody and you have a hard time connecting to investors, if it's your first go, but, successful entrepreneurs are going to find a way to get to those investors. But if you're just hearing no after no after no and you can't find a home for your business, I'm not saying give up, but at least take a hard look at the business, because there's so many sources of capital right now.
As Chang said, we're calling them micro funds in Los Angeles, the group just below her. I'm going to let each of you tell me either about a success or a failure with a technology investment. And maybe I'll start with Amir with Kite, because it's interesting what impact a success has on an ecosystem for other companies. And you started to talk about that a little bit, but if you can tell us about the investment and also the lessons learned, and I'll let you all choose whether you do the success or the failure.
Yeah, so Kite is an interesting story for me personally, because I actually interacted with them twice. One in my previous position at the Weizmann Institute of Science. So technology in Kite actually came from NIH and the Weizmann Institute of Science. So the licenses they took, to get the company going, actually I signed it under my capacity as CEO of the technology transfer company at Weizmann. And then when I came here, I met Ari. He told me the story about actually Kite was incubated here on campus in CNSI. And then they grew CNSI pretty quickly and moved across the street from where my office currently is, and then moved down to an office building next to the DMV in Santa Monica. And I think that their success story, it brought a multinational pharma company here to Santa Monica. And they are supportive of our innovation efforts, and we're creating a dialogue with them. But also we're looking forward to see all of the senior executives of Kite who are either left or will leave in the near future, starting their own companies. I mean, obviously Ari and David Chang already opened Allogene, raised, almost $500 million in the quickest biotech IPO ever. 6 months from starting the company to going public. But there are others who will open companies, and hopefully they will stay here and help us build the San Diego or Boston-like ecosystem around life science.
I could go. A most recent success was selling Ring to Amazon last year for over $1 billion. No, earlier this year. This year for over $1 billion. And Ring is headquartered in Santa Monica, and it's created a lot of jobs for Santa Monica. And Ring continues to be in Santa Monica, and Jamie is now the head of computer vision at Amazon. So I think that has been great for just bringing attention to the local ecosystem, building the talent in the local ecosystem. And in the future, perhaps there will be new Ring spin-out entrepreneurs or Ring spin-out angels.
Our biggest success was Dollar Shave Club, which was I think the second or third company we started. So we got sort of caught lightning in a bottle really early. And as I said earlier, it was Dubin and his partner and a pallet of razors that the background history on how they ended up with the pallet of razors would make like a great 90-minute comedy special on its own. But he'd come to us and they'd run a couple of Groupons at that point. I mean, that's how they were sort of trying to go to market. And we helped obviously put a company around these guys, and then brought in the design and tech and operations and everything else that they needed to figure it out. But that business, the secret of Dollar Shave Club is, as in the video, he tells you that their blades are effing great, right? Which is totally true. But they didn't go head to head with Gillette on their blades. They went head to head with Gillette on the buying experience of razors, right? Which, as anybody here that's actually had to go to CVS or somewhere else and be treated like a criminal while you stand outside this locked box, you're pushing a button. 10 minutes later, some CVS employee shows up and unlocks it for you so you can go spend $50 on 6 razors, right? Like, that experience is horrible, right? And that's what he recognized is I can compete with them on this experience as long as my product is, a good enough substitute for theirs. And he was able to carve out a huge chunk of the market. I think he was up to 17-18% of the entire razor market when he was acquired. And they continue to now be a standalone subsidiary of Unilever, operating out of Marina del Rey. And I think there's 400 people or something working for that company at this point. So, I think that's our biggest success. But along the way, it often looked like it was going to be our biggest failure. None of these companies, and other than maybe this biotech company that went public in 6 months, but very, very few companies are sort of like beginning to end straight shot, up and to the right to success. It's far more often a bumpy road. And the bumps in hindsight, get glossed over when you're telling the glory stories of Ring or you're telling the great stories of Dollar Shave Club. You're not generally talking about the nights where you're up at 2 a.m. thinking you might go out of business the next day, which almost always happens to all of these companies. And it's about, getting through that night and into the next day that allows you to have the great stories of Ring or DSC or going public in 6 months.
I have one more question, and then we'll open it up to Q&A from all of you. But given the talent and the resources here in the audience, can you share how you work with legal teams and attorneys? Do you have an in-house team? I know several of you use outside counsel as well, and what roles they play both for your firm and your portfolio companies?
We exclusively use outside counsel for all of our deals. And whenever we sign a term sheet with a startup, then we engage an outside counsel as our investor counsel. And sometimes if the startup doesn't have their company counsel, we may make recommendations for company counsel as well. And so we work with legal counsel through the close, and that is typically the same counsel that we use for the follow-on financings that happen. There are also other cases that we use counsel for. For example, if there's been an allegation of sexual harassment, we will hire a counsel to do the interviews and the documentation and to prepare an external opinion. If we deal with other types of issues like need to make changes in the executive team and prepare a separation agreement, we also engage with counsel.
So for us, it's complicated because we're part of the UC system. So we use a lot of outside counsel for our patent prosecution and maintenance. We have an in-house department that does the administration, but all the drafting, office action, all that stuff is done by outside counsel. The UC system there's only one general counsel organization that goes from Oakland to campus counsel, and they don't have an outreach to various departments. So we have in-house people who are JDs, who are certified attorneys in California, certified under the US USPTO, but they do not act as counsel, as officially as counsel. They do legal work, but they're not university counsel. And then if we need to go into some enforcement proceedings or litigations and things like that, also done through outside counsel, but we have to go through basically a tender process to choose counsel using the services of General Counsel Office in Oakland.
I'm sort of chief traffic cop at Science. I am an attorney, was general counsel of our first company. Our first vehicle was set up as an operating company, so we sort of had more operational specific roles there. I use outside counsel. Fenwick is our primary counsel for the incubator. Cooley is our primary counsel for our fund. Skadden is the primary counsel for the ICO and for the blockchain vehicle. We have ridiculous legal bills. I mean, for all the attorneys in the office, I'm sure in the audience, I'm sure this comes as great news. We maintain a great network of firms that we use for specific reasons at specific times, and I think we've probably dealt with every law firm in the country that is doing any sort of volume of startup-related businesses.
Do we have any questions from the audience? Here, over here, can you introduce yourself?
Yeah, Mike Barr, I'm a lawyer in town, and on the last panel, we heard about the challenges of hiring people for these types of startups or technology companies in the area. One of the things that one of the panelists said is that it's sometimes easier to hire from New York than Santa Monica. So two of you, I guess, So I wonder if you could talk about those challenges and how you overcome them, or how you advise your companies to overcome them.
So Greg has a little bit of a different take. We were just talking about this.
Well, I think LA, there's certainly always a battle for talent. I don't think it's as severe as the Bay Area right now. So in a lot of ways, LA actually has a strong advantage over the Bay Area where, if you have talented developers on your staff, they're almost inevitably going to be at least attempted to be poached by Apple or Google or whomever up there. LA also graduates more engineers every year than any other city in the country. So there's no shortage of tech resources. They can be difficult at times to find, and the best ones are obviously always in demand. One of the things that we do for our companies, we actually have a 60 or so person development office in India. So when we're working with super early stage companies that don't have their own development resources, we can connect them with our dev shop in India to do the internal sort of first few iterations of the product before they get to the scale where they can sort of hire their own team.
I also think that the difficulty of a startup hiring depends on a number of factors. One, which is, are you in stealth? If it's in stealth, it's really hard for other people to know how credible your company is and whether they should give up their job at Google to work with you. But if you have good PR, because you have launched a product and it got picked up by Vanity Fair, or maybe because you raised funding from science or from UpFront, it helps you to put the stamp of approval of credibility of why should someone join a startup. And also depends on, I think just how well you focus on talent. Like we just brought on head of talent to UpFront. Megan, she grew Hulu from 100 people to over 1,000 people, and then she was on the founding team of Vessel, which I think was acquired by Verizon for $300 million over a few years. So she has seen a lot of talent acquisition, and so she helps all of our portfolio companies to think about their talent strategy, and she will also help to interview and recruit candidates for portfolio companies using UpFront as a platform. And other thing that she does is she works with all of the local talent recruiters, and she knows who's good at recruiting what talent, and she will broker introductions to portfolio companies for certain hires.
Amir,
So we are in probably a more difficult situation than the local startup companies because we can't offer equity, and we're all university employees. And so just in the last 2 months, I think I lost 3 team members who are PhD MBAs to local tech companies or pharma companies. So for us, it's a huge pain. We've no evident solution in the horizon, I'm sorry to say.
Yeah, one of the things we were talking about before is with unemployment so low, we all have to be very good at selling our value proposition and being storytelling in a way that's compelling to people. And then also with the cost of housing where it is, especially for the employees at lower salary levels, it's leading to longer commute times. So considering flex time and remote working where you can do it gives you a huge advantage in getting talent that doesn't want to move when they have kids at a certain age or change school districts, but it is a real issue here. Thanks. Anyone else? Right here in the black?
Hi. Good morning. Thank you. This question can actually be addressed by all the panelists, but I'd like to start with Amir first. How do you handle conflict with the innovations that you decide to fund? Like if they're in conflict, if the innovations are, let's say, in life sciences, and you decide to fund them, but they go in conflict because they're assessing the same thing using the funding, but they meet their milestones different, faculty members may be supported by different, so how do you address that?
A lot of dialogue and transparency, and we work closely with the dean's offices throughout campus. And so wherever we reach a conflict with potentially a faculty member, basically it's data-driven, kind of show, okay, you were asked to reach this milestone, you didn't reach it, we don't have the funds to support you any longer, your dean probably won't fund you anymore for this project, so there's nothing else to do unless you're able to, start up your own company, which we're willing to help you to do, and raise money on your own, which is always a viable option.
And Amir, correct me if I'm wrong, if we file for patents, they come from the University of California and not UCLA.
Yeah.
So people on multiple campuses might be working on the same technologies at same times, and then is it Office of the President with consult from people in your role that determine who would receive a patent?
No. So,
No.
yeah, all of the IP is registered under the Regents of the University of California, but each campus is a standalone and virtual entity as far as the patent decision making. So it's basically up to the USPTO to decide which patent will make it all the way through.
Okay, great. And in the blue?
To all three, what percentage of the companies do you typically take upfront in the initial stages, wherever your company feels comfortable being in the initial stage?
I think he's talking about pricing in around and just, what's a common equity stake for you, given where you invest? And could you just talk about pricing in general right now? Is it frothy? Do you think it's a good time?
Startups are so cheap right now. Not all super frothy. We like to write, so we have a very focused model. We have our sweet spot for check sizes are 2 to 6 million, and we have a target ownership of 20%. And it's primarily because we want to focus our efforts on a few companies, so have a very concentrated portfolio and very active investors with those companies.
Science gets involved with companies one of two ways. We either partner with founders or we create the company ourselves and then bring in a management team to run it. So at some stages, we may own 100% of the company before we bring in the management team. And we've had success under both of those models. So a company called Hello Society that we sold to the New York Times, we sort of created internally and then brought in the team to run it. Others, when we're working with entrepreneurs that have their own concept, we come in as a co-founder, right? So you're getting all of the science resources generally as sort of the third co-founder of the business, and we take third co-founder size equity, so generally between 30 and 35%, which means it has to be a fit on both sides, right? Like for most entrepreneurs or most businesses that come through are not a fit for us because we, for whatever reason, we don't want to get involved with the business. But for a lot of businesses that we do like, entrepreneurs, it might not be a fit for them, right? They have to believe that they're getting enough value that they're ultimately going to do at least 33% better than they would without us in order to give up that size equity chunk. I think our track record shows that on average, our companies certainly do better than the average startup, but it's sort of got to be a marriage and a fit on both sides. On the fund perspective, we're sort of in line with most other funds. We're targeting at least 20% ownership, but that's when we're getting involved with investments outside the incubator. When the fund is investing in companies coming out of the incubator, it invests on terms that are set at the time of the incubation deal. So the fund has the right to put in the first, chunk of capital on reasonable terms that are neither overly favorable to the fund nor, outrageously in favor of the entrepreneur. And so the founder knows that if the business is succeeding, they don't have to then go spend 2 to 6 months going out and trying to raise that first slug of capital. They can focus on running the business, and that will put in that first chunk of real capital.
So we're making our money on royalties most of the time. So we'll take small equity pieces, low single digits mostly, unless we have some investor from the innovation fund. But our core business model is royalties on sales.
I think we have time for one more quick question. Yes, in the gray.
Jason West, lawyer locally. The question strategy, liquidation? What is your approach? Do you just buy the stakes to hold them as forever in the company, or do you plan to go out the IPO? Or what is your, once you've got past the startup and you're moving on, the company's growing, what do you do with your investment, or how do you envision investment going?
We still have an investment that we made in 2002 or 2003 that we've now put in tens of millions of dollars that we still are holding. And because we think that this company still has, it is still on a rapid trajectory of value creation. And we think that exiting now doesn't make sense. So perhaps they could be acquired in the next few years, perhaps that they will IPO. We don't know, but we're long-term partners.
I'm waiting for you guys to say something.
We are sort of inception to exit partners as well. I don't think we sort of we definitely don't have an idea of what the exit may look like at the beginning. We have yet to have a company go public that we co-founded. I think we're just sort of hoping for the good exit by trying to make the right bets up front, right? Like all investors, we're trying to back extraordinary teams that are solving big problems with the hope that if they're able to do so, that it produces outsized returns. How those returns come is sort of irrelevant at the beginning as long as they arrive at some point.
Amir, anything?
We don't think the university should run a business, and so we're waiting for the professional investors to drive that process.
Well, we are at the appointed hour. I want to thank our panelists for joining us today and thank all of you. You've been a great audience, and I'm going to turn it back to our organizers.